Good afternoon, everyone. Welcome to our COVID-19 Power Lunch series. Today, we're covering the American Rescue Plan Act, recently passed by Congress and signed into law by President Biden. My name is Erin Spiwak, and this is Mike Sibley, and we're partners with James Moore & Company. There's a lot included in this act, so we're really going to hit just some of the highlights today. And be aware, there's lots of numbers. So we're going to post an article within the next week or so on our website that gives you the full details, so you don't have to watch this multiple times to understand exactly where you fit into these guidelines. So with that, I'm going to start off with the individual provisions that were part of the bill. The one that is being most talked about is the individual recovery rebate credit. Now, as everyone can recall, this is now the third stimulus payment that's being made post-COVID, right? So the first one came out with the CARES Act, which was in April of 2020. And that one was roughly $1,200 per eligible individual. And it was sent out in a myriad of payments between April and May. Then in the Consolidation Appropriation Act, passed in late December, they authorized an additional $600 per eligible individual. And that was also sent out in January via electronic payment. Both of those payments, if you did not receive them, are now eligible to be claimed on your 2020 tax return. This new rebate recovery credit, or economic impact payment, however you want to call it, is now considered an additional credit based off of either your 2019 or 2020 tax return, and I'll get into that a little bit later, but it's going to be advanced to you for 2021, okay? And the numbers are bigger. They're giving $1,400 per eligible individual, plus $1,400 per each dependent, and this includes children and qualifying relatives. What they did to change this credit is they kind of narrowed the scope on who was allowed to get this credit. Before, there was a large range of your adjusted gross income, also referred to as your AGI, that if you were between two buckets, you got the credits. That was part of a compromise between the Senate and the House when putting this act together, that they wanted to make sure that it was a very limited amount of people who could get this credit. So if you file single or married filing separately, and your AGI is between $75,000 and $80,000 or less than $80,000, you will get all or a portion of the credit. If you're head of household, that phase out is $112,500 to $120,000, and married filing jointly, it's $150,000 to $160,000. If your AGI is less than that, you'll be eligible for the credit. If your AGI is more than that, you won't receive any of the credit. They're basing these payments, which they are doing as direct deposit, or if they don't have that information for you, sending you a check, based off the most recently processed tax return. That is causing a bunch of probably most confusion, because even if you've already filed your 2020 tax return, it may have not been processed by the IRS yet, and they may be using 2019 tax return data to issue these credits. If you have filed a 2020 tax return and they've processed it, it'll be based off of that information. But very similar to the previous credits, if you were eligible and didn't receive it, you may be able to claim it on a later filed tax return for 2021. Okay. One of the things we've gotten a lot of questions about is related to kids. So people have said, hey, my AGI is over the threshold, that if I don't think we're going to receive any of those credits. If my child earned income, which typically we see in like high school or really more college age kids, if they file a tax return with that earned income and I don't claim them as a dependent, will that allow them to get the credit? Well, the rule is that they still have to qualify as not as a dependent. And those rules really go back to the rules that have been in place for a long time from a dependent situation that said they have to be able to provide and be providing more than half their support based off of their reported income. So for instance, if they just have a summer job and they earn a $2,000 W-2, it's going to be pretty hard pressed for them to file a tax return claiming themselves and saying they supported themselves based off of $2,000. So it really goes back to the same rules from a dependent standpoint. So that's the individual recovery rebate credit, and the IRS already has a link to it on their website where you can go on and say, hey, where's my rebate credit? Am I eligible? And get the status of that. The second thing that they did that is actually much more complicated than I think they ever intended, or maybe they intended it, they don't file tax returns, is the child tax credit. So for those of you who have children under the age of 17, you may be aware that back in 2018, when the tax law changed, they took away what was called an exemption, which basically gave you a deduction for every dependent you claimed on your tax return. Instead, they replaced that with a tax credit based off of the number of kids that you had under the age of 17 and based off of your income. A credit is better than a deduction because it can offset your taxes dollar for dollar. So in essence, it should have been a better situation for most taxpayers. Well, they've gone in and have expanded this. But they didn't just expand it, they kind of still left it in two different buckets. They made the original child tax credit still applicable, and that is $2,000 per qualifying child. They did expand that definition of kid to say that you are a child if you haven't turned 18 by 12/31/21. So they did increase it for another age of year. But that original $2,000 per qualifying child, you get as long as you aren't above $400,000 when married filing jointly in AGI, or $200,000 for all other filers. This credit was partially refundable, okay, so originally. The new credit now, like we said, expands the age, but it also expands the dollar amount. It says you can get up to $3,000 per child from ages 6 to 18, and for any children that you have that are younger than the age of 6, you can get $3,600. But the key is they said, hey, we're not going to just let it be for anybody who makes up to $400,000. For that incremental difference, they basically said if you want that extra $1,000 or $1,600, you're only going to be able to get this if for singles you make less than $75,000, had a household that 112,500 number, and $150,000 married filing jointly. So next year when you're, or we'll talk about this in a second, but next year when you're filing your 2021 tax returns, there's actually going to be two different calculations of the child tax credit. I'm sure the IRS is already swirling with how to put that form together and make those calculations. Mm-hmm. They also did change it to say that we're going to make the credit fully refundable. So before we kind of mentioned it would have been partially refundable. Now they're making it fully refundable, which rolls into their next thing where they said, similar to the recovery rebate credit, we want people to get this money in advance of filing their tax return for 2021. So they have gone in and said, hey, we're authorizing the IRS to issue the additional tax credit starting in July in monthly installments. So basically that 50% of the child tax credit can be advanced to individuals over a 6-month period, July through December. They did put in the law to say if the IRS can't do this, so for a myriad of reasons, if there's going to be too many issues, they can extend that. So I'm guessing maybe July through February, July through March, not really sure how they're going to do that. They also tasked the IRS with putting a portal in place that individuals could go on and log on if they've had any change in dependents, i.e. they've had additional kids for 2021 that wouldn't have been reported on their 2020 tax returns or 2019 tax returns, and also allowing individuals to opt out of these advance payments. One might ask, why do I want to opt out? Well, because different from the rebate recovery credits that don't have to be repaid if you didn't qualify to get it in the first place, these child tax credits, if you file your 2021 tax return and your income's too high and you got an advance on those credits, you're going to have to pay it back. So this could really, when people go to file their 2021 tax returns, could put people in a little bit of a pickle where they were not expecting to have to refund whatever they had already gotten in advance on these child tax credits. There is a very slight exception for some modified AGI people that there's a safe harbor where you may not have to pay it back, but that's a little more complicated than we want to get into on this discussion. But just be aware that that is out there. So when people say, hey, when am I going to get my money monthly for this child tax credit? The earliest it looks like it's going to be July as the IRS puts all these things in place. Another thing they did related to child is the child care dependent care credit. This also has been around, and the old rules basically said you can take up to $3,000 of expenses if you have one child, or $6,000 in expenses total for all children, and get a tax credit for up to 20% of those expenses. But it wasn't refundable, right? So the most you could get was $1,200. So not a big amount. And for those of you who've ever paid for childcare, it doesn't even come close to offsetting what you're paying in this. And the child and dependent care credit really is, and we get this question a lot, you actually have to report who you paid those child care expenses to, whether it was a business or an individual that you then issued a W-2 to for being a household employee. That actually gets reported on the form. And it's only eligible for kids who are under the age of kindergarten or for after school or camp expenses once they're in kindergarten and over. It doesn't count for private school once you're past preschool, basically. And the other key on this credit is that both parents have to be earning income. So if one spouse doesn't have an income source and you want to claim the credit for your child going to pre-K, it may not be allowed. There are some slight exceptions to that, but they're pretty small. So the child care dependent care credit, they said, hey, we're going to expand that for 2021 and now make it the eligible expenses up to $8,000 for one kid or $16,000 for all children is your eligible expenses to take a credit. And the credit can be now up to 50% of those expenses. So a max of $8,000 if you have more than one child in tax credit. Of course, just like the other things, there are thresholds that if your AGI is under $125,000 and you're spending $16,000 on childcare, you're going to get the full 50% credit, which is great. Once your AGI goes over $125,000 and up to $185,000, that credit gets reduced from 50% effectively down to 20% of your total expenses. Then there's a bigger gap of your adjusted gross income. If it's between $185,000 and $400,000, you're going to get 20% of those expenses. And then basically once your AGI is over the $400,000 and once it maxes out at $440,000, you're not going to get any of the credit. So they put thresholds in here to make sure that these credits are really for people who are making, and the key number seems to be around $400,000. If you're making less than that, then you may be eligible for some of these credits, and really $150 on the rebate recovery credit. The other thing, again, is they did make that credit refundable, where before it was non-refundable. So that kind of covers the different tax credits that are very popular and being discussed. Wanted to also touch on unemployment compensation. This was a big one for 2020, where obviously with the pandemic, and especially in the months when everything kind of went to a shutdown, there was a lot of people who went on unemployment and didn't really consider any of the tax ramifications because they just needed the money to be able to pay expenses, pay rent, and didn't realize that, hey, once I get my unemployment, I'm going to get a 1099-G from the state that shows how much I was paid. Well, Congress said, hey, we want to make sure that people who get unemployment compensation aren't hit with not undue, but maybe unintended tax consequence that they're now going to have to pay tax on it. So they made a rule that retroactive to 2020, and they made this rule last week, so we're in the middle of filing taxes. They said, hey, in 2020, if you made less than $150,000, you can exclude up to $10,200 of your unemployment compensation. And that 150 is flat. There's not a threshold. There's not a phase out. It says if your tax return shows $150,000, you can exclude up to $10,200 of unemployment compensation, regardless of filing status. The big issue with this has been kind of twofold. One, there's a lot of people who've already filed their tax returns and reported that unemployment compensation who are now saying, how do I fix this? How do I get my taxes back? The IRS has come out and said, please don't amend your tax return yet. We're waiting to or trying to put together a process that'll make it simpler for people to get that adjustment so that they don't have to go through the process of amending a tax return, which is more complicated than it should be, quite honestly. They've talked about portals. They've talked about doing an automatic generation based off tax returns. So they're trying to find something that will save people time of having to go back and get the money. Second, for those who have not filed their tax return, and for those of us who are in the process of preparing those, we're kind of stuck in a place where the IRS has not issued guidance to any of the software companies to update the forms of how to exclude this unemployment compensation. Now, we can think of different workarounds to maybe how to show it as excluded, but we're really waiting on guidance because what we don't want to happen is to come up with a workaround and then everybody get hit with these computer-generated tax notices for not reporting it correctly. And the IRS is really good at sending those generated and causing a lot of stress and undue issues. So the IRS has said they're working on this. They're going to get this out to people as soon as they can so that those who want to file by the current due date of April 15th will have a way to do that and exclude that unemployment compensation. And the last thing to kind of go over is student loan discharges. So they did come out and say if your student loan is discharged between January 1st, 2021 and January 1st, 2026, before, under the old rules, that was considered taxable income. It was called COD income, cancellation of debt. And they said there's about 4 different loan types, which is pretty expansive, but it's important that you look at what qualifies for those. If your loan is discharged during this time, you don't have to report it as taxable income. Important to note that if you get a forgiveness of your student loan because of services you're providing in lieu to get the loan forgiven, this does not qualify. So an example of that is I know there's a lot of teachers who can go work in underserved areas, and if they're there for 5 years, all their student loans get forgiven. That, in theory, should be taxable because you're trading services for getting the loan forgiven. So with that, I'm going to turn it over to Mike to talk about some of the business provisions.
All right, thanks, Erin. Well, and there's a lot in this act, obviously, as you just heard, just the individual, some of the individual side of things. And there's a number of business provisions, but I'm going to just really focus on a couple of them. And then I want to get into a couple of other reminders on employee retention credits and some PPP developments that have happened over the last few weeks. So first, I'm going to start with some of the business provisions. And the first one is the targeted economic injury disaster loan advance. So otherwise known as the EIDL. We always just, shorten it, call it the EIDL. And you may recall back in March of last year when this first became a common term. I don't know that most people ever even heard of this kind of a loan before or had this idea of an EIDL, but it was an advance, and you could log on to the SBA, you could put in your information, and you would get this advance. And then the PPP came along, and then there was a lot of confusion because, oh no, I've got this advance and I got the PPP, and now I'm going to have to pay back this advance. Fortunately, when the act that was passed in December 27th, that actually changed that and said, no, you're not going to have to pay this EIDL back. But it also created this concept of a targeted EIDL. And so this does go back, and again, it was additionally funded as part of this most current act. But the idea here is that it's going to focus on a targeted economic level. So it's looking for low-income areas that have had businesses that are in low-income areas that have had substantial reductions in revenue. And what's really, really interesting about this one is right now it's not something you can go and apply for. The SBA is actually going to reach out to you, which is a little bit odd. And I know a lot of people, when it comes to getting emails, are worried about fraud and clicking on something, and next thing you know, you've just sent, money somewhere. And in fact, if you go to their website, they'll actually give you a warning. If it doesn't come from SBA.gov, don't click on it, don't respond to it, those kind of things. So they are actually going to be reaching out. Now, beyond that, what happens when if they reach out to everyone, they don't get the responses, will they open it up? That's still, in my mind, remains to be seen. I think for those in that area, for small businesses in particularly, I think you should be frequenting the SBA.gov website. There's a whole COVID page, and they have links to every single opportunity, every loan, every grant that's out there in these provisions for the last year that you can potentially, hopefully, take advantage of. So that's one of them. The targeted EIDL is one of them. The next one that came out with this recovery plan was the restaurant revitalization grants, hard to say, RRG. So this one is about $28 billion worth of set aside for restaurants, particularly small restaurants. So starting with those that have 20 locations and less. But they're going to even set aside, even for the first chunk of this will be set aside for those that have revenues below $500,000. So it's going to focus on that, and then it'll grow from there to those restaurants that have up to those 20 locations, including franchises. Franchises can, but if it's a government-sponsored restaurant or government-owned restaurant or publicly traded, it's not going to apply. You can almost think about this like another PPP. It's similar to a PPP. Now, what the focus here is consider it like revenue recovery. So they're going to compare your 2020 revenue to your 2019 revenue, and that difference is going to be the basis for the grant. Now, at this point, and you can go and you can watch by going to the SBA.gov, the guidance isn't out on this. You can't just go and apply for this just yet. So, but it is, if you're in the restaurant industry and you fit that small size restaurants, then you need to be paying attention to this. You need to be visiting the SBA.gov to see when this comes out. You may be part of a restaurant associations or something of that nature. While I use the word restaurant, it is important to note it goes beyond restaurants. It's in the food service industry. So it could be bars that fall into that, and others within. I think it's going to somewhat follow that same, again, since probably most of you are familiar with the PPP at this point, that 7.2 NAICS code that we've been using. As you know, from a PPP standpoint, any business that uses a 7.2 is allowed to get a 3.5 times multiple of your monthly payroll. Now, this is going to be different from that standpoint in terms of the calculation, but it's that same concept, that same industry group is where they're targeting, only on the smaller size. Now, it uses a lot of the same terms. You're going to have a covered period. So you'll have a covered period that goes through the end of this year, and you're going to use the monies on payroll expenses and on some operating costs, rent, utilities, those kind of things. So it's sort of a, I don't know, perhaps almost a PPP3, only it's not based on payroll at this point. So again, I would suggest visiting the SBA.gov in order to keep. And again, we're going to cover this, as Erin mentioned early on, a lot of these provisions in an article that'll be up and coming, so you can be aware of that. With that, I do want to switch gears a little bit on some reminders and some developments that have happened over the course of the last couple of months. First of all, is hitting this employee retention credit, and this isn't necessarily new of recent, but obviously it changed back in December. But effectively, if you got the PPP, so if we go back to 2020, and we got a PPP loan, we couldn't get this employee retention credit at the same time. You couldn't get both. They changed that to now you can be considered for the employee retention credit. And that credit, the basis of it was you had a quarter that was decreased in revenue year over year by 50% or more. And that was your starting point. But the piece that we have to be careful on is that we can't use the same dollars for the PPP. So if we use payroll for forgiveness, so let me say we got a payroll protection program loan for $100,000, and we had payroll from May or July, August, September that covered that, as an example. Well, we couldn't, and we needed every one of those dollars to get our forgiveness on the PPP. Well, we can't then use those same dollars to go get a credit on a payroll tax return for this employee retention credit. So we have to be very careful. But the way the PPP worked is you had a lot of flexibility. When first you start with where was your cover, when did you get the loan, and then you went out, and as soon as you had enough payroll, you could apply for the forgiveness and use that. But it doesn't mean that you weren't, obviously we're continuing to get payroll after that, so some of those dollars may be able to be used. We just have to be very careful about how we complete that forgiveness application. In some cases, it may already be done. There's some other nuances to consider from a tax return standpoint, and of course, the IRS is still just recently issuing guidance on this, so we're still trying to learn and figure out the best way to move forward. This did carry into 2021, so in 2021, we're now using a 20% revenue reduction factor rather than the 50% reduction. So that is still out there. It's obviously got some complexities to it, and if you're doing PPP and getting forgiveness on that, we just have to be very careful. So we have to plan that out and make sure. But remember, with the PPP, 60% of it has to be used for payroll, but you can also use other non-payroll items. So if it makes sense to maximize a retention and credit, there are ways to kind of take a look and say, okay, what's the best way for our business, given how much we're hurting, to maximize these opportunities. And that's what we really want to focus on there. Jumping back into PPP, which is Erin and I's favorite topic. We are now at a year, I think, or close to a year of talking about PPP, although the interval has gone a little bit further apart here. But back in February, there was a change for small businesses, sole proprietors who file a Schedule C. And the idea was that our Schedule C filers were really not able to take advantage of really replacing income, helping get them larger loans. So what they said is, hey, you can look at it one of two ways. You can do it the current way, which is based on the net income of the Schedule C, or you can look at gross revenue. And now that was still limited to $20,833, but for some that was, if you had net income of a couple $1,000s, that was really all you were going to get was a fraction of that. But your gross revenues, on the other hand, could get you somewhere between that bottom line number and the $20,833. So they actually allowed a replacement. Now they didn't say, now if you already applied, you already got the loan. Unfortunately, they haven't changed that yet. But going forward, if you haven't applied yet, you have an opportunity. They actually revised the form. They have a special application for this now, and there's different nuances to the calculation if you have employees who work for you. If you don't, there's a couple nuances there, but it's really important that you know that has changed. Now, one of the things to look at here is, I know a lot of people have been behind on getting their financial information to either in for tax preparation or just being able to pull it all together. As it currently stands, and this seems like it's going to change, the deadline to apply with the SBA for a PPP loan is March 31st. Now, we've all gotten news alerts today that the House, on their side of things, have passed an extension to May 31st. Obviously, this has got to go through the Senate, and then assuming the Senate doesn't make any changes, or assuming they pass it and don't make any changes, then it goes to the president to sign. I am expecting that will happen and give a little bit more time. But for those that have not applied yet and you're pulling your information together, keep in mind there are other ways besides just completing to see if you qualify, and that's, you can use bank deposits, and there's a number of other avenues, particularly for small businesses, to quantify whether or not you qualify. Of course, you still have to have the economic uncertainty and things of that nature. So I do think that's something to take a look at and be cognizant of. That as it stands now, we are running out of time, but we do think that's going to change. I also, what some of the things that we've experienced in working with the SBA through our lender friends and our portal is that the SBA is taking longer to get through some of this stuff. There's been a lot of error codes. Obviously, as you can see, now they've got all these other business provisions that they've got to deal with as well. So they've got a lot that is going on. They tried programming, new fraud checks, and talking to some of the lenders. The SBA is trying to give these lenders the secret decoder to these error codes. And so how to resolve these error codes, and it's not through a fault of anybody who's applying, it's just these error checks that unfortunately didn't work. So you will have to have patience. It could take substantially longer than it has in the past to get funding, but rest assured it will come through, provided there's not an error on the your side of preparing it or putting any information in incorrectly. Now, we've seen if information did get in incorrectly, they're still working with you to get through that information. So, but it is important, I think, certainly reach out to get help, to summarize, to make that more efficient. But just remember, if you're waiting on it, maybe you've already applied, it'll come. It's just a matter of, it's got to work through the system. It is taking a little bit longer. And with that, Erin, that's what I wanted to cover this afternoon. I'll turn it back over to you.
Thank you, Mike. So, and just one quick question, which you may or may not know the answer, I'm putting you on the spot here, but on the restaurant revitalization grant, or RRG, it's going through the SBA. At this point, we don't think it's going to be administered through banks like the PPP, right?
No, everything, my understanding is that you're actually going to apply on the SBA website. Yeah. So that's a way different thought process than what we've had with the PPP. I don't know if that's good or bad or indifferent. Maybe it'll help streamline it a little bit. I don't know, but that's my understanding. And certainly as we get more information on it, we'll try to send that out. But yeah, it's a great question. I believe it is going to go through the SBA website.
Which does make sense. It's a grant, not a loan, right? So the bank doesn't have to administer anything. So
Yes.
just want to make sure people are kind of aware of that before you call your banks or get really stressed out because they haven't opened their portal. It's going to be going through the SBA on that piece of it.
Yes, that's a great point.
And then, as Mike mentioned on the employee retention credit, as well as I always mess it up, FFCRA, Family First Response Coronavirus Act, something. There was changes that happened in this. Mike hit some of the highlights. We do plan on either releasing additional articles. We have sent out e-blast on it, perhaps even doing an e-blast on, doing a webinar on it, because the rules keep changing and the IRS keeps issuing additional guidance, and it is getting complicated. But be aware that you may need to or be eligible to file amended returns for 2020 to get this credit, or you may need to do it on your first quarter 941s for the current year for 2021. So with that, we thank you for joining us and asking all your questions. And if you have anything else, you can always get us at info@jmco.com or submit it through our website, and we'll do our best to answer you with the information that we currently have. And like Mike said, these COVID power lunches, we used to do them weekly, twice weekly. They definitely have stretched out, which is a good thing. Hopefully we won't have to be calling them COVID-19 power lunches in the near future. But as the information keeps changing and they keep passing new laws, we want to keep everybody as up to date as possible. So with that, thank you for joining us.